This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Martha Kocher with our experts Manus Clancy and Diane Crocker. For the week of November 18th to the 22nd, investors digested a host of economic data on housing, retail earnings, and a round of Fed speakers commenting on the path of the interest rate policy. But most of the focus was on the potential impact from Trump cabinet appointments and the heightened tensions between Russia and Ukraine. Manus, the 10-year Treasury was up 4 basis points at 4.418%. Are investors pretty concerned right now?
They are very concerned, as am I. We are certainly heading in the wrong direction. Since mid-September, when the Fed announced their 50 basis point rate cut and the 10-year Treasury hit about 3.6% around the same time, it's been almost a steady increase. Now you're saying we're at 4.4%, up 80 basis points. Certainly not the direction that CRE buyers, CRE property owners want to see the 10-year going. It's driving up the cost of capital. It really goes right to the bottom line. An 80 basis point uptick in the 10-year really corresponds to an 80 basis point uptick in the cost of funds for anybody using long-term fixed rate debt. So that's a negative. I've been on record as saying I was not crazy about the 50 basis point rate cut. I was equally not crazy about the 25 basis point rate cut in the past, with stocks near all-time highs, with housing near all-time highs in many markets, with inflation still stubbornly high for many consumer goods. It seemed like a reckless path to cut 75 basis points. I fear that they may do the same thing in December and make it a full 100 basis point decline over 4 months. Certainly for people using floating rate debt, that's a good thing. For banks, it's probably a good thing. But I am really concerned that we are moving in the wrong direction as it pertains to long-dated Treasury yields. And that's not a good place for us to be as an economy.
You know, Manus, it's funny, the holiday season's upon us, and as I read the news lately, it feels like someone keeps shaking the snow globe. You know, those snow globes we played with when we were little. Between the Treasury going up, as you talked about, and now being at a 4-month high, every time Powell opens his mouth, I feel like the likelihood of a December cut goes down. And it's just things are changing week to week. And now that the election's over, obviously the focus is turning to various potential inflationary pressures, whether it's, policy changes like higher tariffs or other things that Trump could put in place. And any inflationary impacts of his policies are obviously going to weigh in on when and how fast and how far the Fed cuts rates. It was just last week when the futures market was pointing to a 60% chance that the Fed would cut rates in December. And now I think I read traders are pricing in a 45% chance of the Fed hitting the brakes. So it's just kind of a sense of that snow globe being shaken, from week to week, and the market doesn't know what's going to happen next.
I think one of the big items right now, some of the financial press has been reporting this for a while. I'm not sure the more general press really has tapped a nerve into the public, but it's certainly weighing on traders and money managers right now, is just the size of the U.S. debt. Something when we went from 32 trillion or 33 trillion to what is now 35 trillion seemed to really tap a nerve. And I think a lot of this uptick in Treasury yields over the last 45, 60 days has been a reaction to, wow, neither party is willing to tap the brakes. We are on a runaway train right now. And the only way that we can continue to sell treasuries month over month, auction after auction, is for rates to go higher. And I do think that is the bottom line concern right now. I think that Wall Street has awoken to the fact that this is not a black swan event that is going to be more difficult to sell our debt. It's a real event. And it's unsettling for everybody who's in the financial markets right now. I would add one more thing, and I'll be eager to get your reaction, Martha and Diane, to this. I usually feel fairly confident as to which way the wind is blowing. I may not be right, but I certainly have strong opinions usually as to, are we doing a soft landing? Are we doing a hard landing? Are we doing no landing? I feel like when you look at the data, or I look at the data, I could parse through it and get a firm grip on where at least I can form an opinion. I do feel right now, I feel as unable to form an opinion as at any time since early 22. Why is that? In early 22, the Ukraine war had just broken out. Oil prices were bopping all over the place. People were really on edge. COVID was still very much in front and center in everybody's minds. It was very hard to know where we were going then. And we know what happened next. The economy really took off. Now it feels like we're at a very similar point right now. Are the tariffs going to be big or not that big? If they're big, how much inflation will that drive? Will this uptick in hostilities in Ukraine lead to other countries being pulled into this? Will NATO be involved in this? On the more positive side, if Trump's cabinet nominees look to shrink the size of government, will we finally get our spending under control to some degree? Will we start seeing deficits of less than $1 trillion a year? I don't know the answers to any of these things, and it's quite unsettling. I just really don't have a strong sense of what 2025 will bring.
It's incredible how quickly things have changed. For me, in talking to our clients, the first two rate cuts, they were just really such an important and obviously long awaited inflection point. It gave people a sense of more stability, less volatility. It gave them a reason to start thinking about borrowing, to thinking about buying properties, to thinking about selling properties or lending again. Then the election happened. And now, as you mentioned, we speculate about whether Trump is going to go full on with his tariff proposals. And if he does, what does that mean to the prices of things like toys and clothes and furniture and appliances? The National Retail Federation reported this week that major retailers are already planning price increases. I agree. It leaves so much uncertain, including the geopolitical pressures that you talked about as well. It gives us things to speculate about, and we'll see what kind of gains clarity in the coming weeks. And we all keep talking to each other about what we're seeing and hearing in the market, but it definitely puts us in kind of an uncomfortable place as we approach year end.
And certainly the data is doing us no favors. I know in a few minutes we're going to talk about some of the retail earnings, but even when you're looking for clarity there, pre-tariffs, right, with the economy still just chugging along as it is, you're seeing very diverse results. And I think that adds to the unsettling feeling that I have that is it time to be bearish or is it time to be bullish? And for right now, I don't have a strong grip on this.
And, I thought it was interesting that we saw several reports this week with Wall Street coming out very bullish on stocks for 2025 and providing some estimates and forecasts that are some new high watermarks.
Certainly, I was happy to see that. I would love for that to be the case. I think Goldman said their target is up 11%, something like that for 2025. I think Morgan Stanley was in the same neighborhood. Put me in the camp of skepticism. I don't know how we get there in the current path. It seems like the Fed might be in the process of blowing it with these rate cuts, that inflation could become another issue next year. We have no idea where tariffs take us. I am hopeful that we can start reducing our spending, but that's no sure thing. Am I banking on 11% next year? I don't know. I'm thinking I'd be happy if we get low single digits and we avoid a cratering at any point during the year.
For doing our 2025 predictions, Manus, we're going to have to all pull out our dartboard or the Magic 8 Ball or the Ouija board or whatever we use to forecast during uncertain times.
I'm ready.
So turning to retail earnings, we saw a slew of earnings, and it was interesting because you saw a contrast in a couple of earnings, Target and Walmart being the examples that I'm thinking of. We also got some guidance in terms of where they think earnings are going to end up for the fourth quarter and the holiday quarter that they think in some cases will either be strong or a disappointment.
The difference was utterly staggering, wasn't it? Target down 20% after they lowered guidance, talked about holiday sales being off. Meanwhile, Walmart continues to hit record highs all the time. Their sales continue to surge. It goes back to my remarks a few minutes ago. How do you weigh this? How do you handicap where we're going to be in 2025, where you see such a diversity of results. But I'll ask both of you a question. I have my own opinion on this, but I'd like yours. I see Target as a slightly more upscale version of Walmart. Walmart continues to thrive because they are the low-cost provider and they have the low-cost perception. People continue to gravitate there from places like Target or maybe other places like Burlington, maybe, or Macy's and other retailers. I don't know. Whereas people think Target is a little bit of a luxury. I'm going to trade down to Walmart. What do you think? Is that fair or is that unfair?
I think you're right on the money. I think Walmart has a very clear brand position as a value place for shoppers. And they've talked about how they've captured the affluent shopper, people with earnings of $100,000 or more are now buying at Walmart. And I think Target, for the good or bad, suffers from the fact that they are perceived as a discretionary shopping venue. So people go there for clothes and for, house goods and some other things, not necessarily for groceries and other essentials that I think Walmart really just owns that space.
Well, that would certainly explain the divergence of earnings, I suppose. That was my gut. It seems like you're confirming what I felt like. That I get my food from the Quickie Mart and the my clothing from secondhand. So I do need that second opinion as to how the retail market shapes out.
And it could just be a shift, to your point, Martha, of folks that would normally shop at Target that are now maybe being a bit more cost conscious, and maybe they're doing their holiday shopping at Walmart and even the Dollar General stores where they would normally go to Target. So it definitely was an interesting mix as I looked at Target's earnings next to Walmart's.
We also saw TJ Maxx, parent company, and Lowe's report earnings. And again, the story I think is one that's not a great story. TJ Maxx said their holiday shopping was off to a good start, but then, of course, their guidance took us in a different direction where they said fourth quarter was not going to be as strong as they had hoped.
So let's take it to a personal level. Have you ladies started your holiday shopping yet? Has that begun? Are you going to be contributors to the retailer's bottom line this year, or are you going to be holding back a little bit? What's your personal vibe at this moment?
I am impacted by having a kid who's about to go to college, so I am definitely a cost-conscious shopper this holiday season. But I'll add, Manis, that I just saw a headline that I'm sure you're familiar with this, and you too, Martha. The huge light show that goes on Fifth Avenue across from Rockefeller Center is that Saks. And so one of the casualties of reduced spending at the luxury end of the retail spectrum is that light show has been canceled. I think I read for the first time in 20 years. Is that Saks?
Yes, that's terrible.
Mm-hmm.
That's awful. Yeah, and I did want to point out too that both Walmart and Lowe's had some warnings about some potential trouble with costs if Trump goes through with some of the proposed tariffs.
Yeah, a similar remark was made, I believe, by the Target CEO as well. It's a big concern, and it's part of the reason that it's hard for me to get bullish about these 11% expected gains next year. Just way too many unknowns at this point.
Black Friday is always kind of a bellwether as like the first sign of the strength or weakness of retail season. So it'll be interesting after next Friday, see how the numbers compare maybe to prior years. I'm sure we'll see a lot of reports about that as well.
And while we're talking about retail, Manis, I came across this story that I thought was close to your heart. American Dream Mall. Our friend Ryan Paskus at Commercial Observer wrote up a story that perhaps the nightmare for American Dream Mall has turned the corner. They're paying off their debt and foot traffic is picking up. I know we've talked about that story many, many times in the past, and they've been beleaguered as a post-pandemic victim.
The Dream Mall. For those that don't know, this is right near the stadium where the Giants and Jets play, MetLife Stadium, right off the Jersey Turnpike. Quite an eyesore. It's been under development for more than 20 years. I believe that there have been 4 bankruptcies around this mall in the past. A big developer a couple of years pledged collateral in 2 big U.S. malls to acquire the Dream Mall. They ended up losing their stakes in 2 other malls because it defaulted for the 3rd or 4th time. at that point. So a real travesty of a story. It's great to hear them turning things around. But I will give you a contrarian take here, Martha, and you can weigh in if you want. This thing is so close to Giant Stadium that you could throw a baseball from the mall to the stadium. That's only a mild exaggeration. My thesis has been nobody ever wants to go there because, especially on the weekends, because there's always college football and NFL football. Who wants to get caught up in this traffic? This year, the Giants and Jets are so bad and nobody's going to the games that people think, hey, for once we could check out the Dream Mall. There's going to be nobody around the stadium today. Let's go check out all the different amenities they have there. Like if the Giants and Jets get better, let's see how the Dream Mall does then.
You're right. I'm still hurting from the last week's Jets loss. That was terrible.
The Jets couldn't beat Rutgers these days, I don't think.
Okay, let's cover some sales, Manus.
Well, one of the silver linings about the fact that rates have been going up is the fact that sales continue to march along really without any interruption. I've said this before that for several months over the summer into September, we had been expecting 30 or so sales per month of 9 figures and up. In October, we saw more than 50 of such sales, and that's a great sign. And what we're seeing right now is a continuation of that. I know last week we had a guest pod, so we didn't go through any sales, but I'm just looking at my data right now. Over the last 2 weeks, we're seeing, it looks like 12 apartment sales of 95 million or up. The biggest one being in Redmond, Washington. The Parkside there went for 286 million, 430,000 per square foot per unit. Lakeside Capital, the buyer. But what's great here is the diversity of cities. We're seeing Redmond, Phoenix, Redwood City, Santa Ana, 3 in Denver, 1 in Aurora, 1 in Philadelphia, 1 in New York. And the buyer group is diverse too. Lakeside Capital, Brookfield, Acacia, Bridge Investment, CIM, Graystar. So even though rates are moving higher, buyers have yet to slam the brakes on. Maybe they're tapping the brakes here and there, but the fact that these things are taking place is a terrific offset to the narrative of rates going higher.
And that's what I was wondering, Manus. First of all, your stat of the rise in these 9-figure deals in October is one of my favorite stats from you of late, obviously because it's a dose of optimism. But I wonder, in light of everything that we've talked about already today, are investors going to pull back given the high degree of uncertainty? Do you feel like these deals were ones that were already in motion, even in advance of the election? And, I wonder what November's deal making and obviously December's will show.
I do agree with you that these deals take some time, and it's hard to stop a train when it's going 60 miles an hour and it's halfway towards its destination. So some of these sales may have been in the works before Election Day or even maybe 45 days ago. But the good news is that thus far in November, we seem to be on pace for seeing something north of 40 sales of 9 figures and up. Interest rates started going up mid-October, maybe earlier. We're now 30 days into that, and thus far the damage has been negligible in terms of slowing deals off. I think December, January, February will be interesting months to watch for the impact for the reason you said.
We'll run the November index in 9 days when November ends, and the 3 components of that, property listings, lender appraisals, and environmental due diligence, are early indicators of the deal-making climate. So we'll definitely have all eyes on those stats to see if it indicates any kind of a shift.
And Martha, I do want to bring up one office sale, which I thought was really, really interesting this week. I talked about it on my Twitter account during the week. I did talk about it at length. And this is 799 Broadway, which sold for $255 million, 799 Broadway in New York. And why was this such an important sale? It's such an important sale because the owners of the property, Columbia Property Trust and Cannon Hill, a couple of years ago, 2 years ago, in fact, took out a $265 million loan that went into a CMBS deal. That loan went into special servicing. A workout was being considered, foreclosure was being considered, and in swoops Savannah, acquiring the asset for $255 million which is about 97% of par. And if that isn't a bright spot for the New York City market, you're getting a 9-figure sale. You're getting only a de minimis loss to the bondholders in the CMBS market. And you're getting 97% of par, all of that. And you have a buyer who wants to operate this property, Savannah. So by all measures, the office market has been beleaguered for a long time. It's been terrible. The comps have been awful, often 20, 25%, 30%. This one is a modest bright spot in an otherwise bleak market.
And turning to our LightBox data dive, we're going to look at sales.
Yeah, this one jumped out at me. I had a bunch of people coming to me asking for data in the last week or two, which I was happy to provide. And the question was, are we seeing a lot of land sales? Are those land sales pricey? And the same question was asked of conversions. Are we seeing a lot of that? So we went through the data, and what we found was that there were a couple hundred land sales that have been announced, including 15 land sales of $100 million or more since early 2024, many of those for data centers, 40 sales of $50 million or more. That's just land. Next week in the data dive, I'll talk a little bit about the transition sales, which are also quite plentiful, office to residential, office to hotel. But the big one last week, the big land sale, Iron Mountain paying $113 million for 40 acres in Manassas, Virginia. Manassas, Virginia seems to be the epicenter of where people are buying land for data centers and other high-tech operations. It has really been taking off several 9-digit sales over the last 3 months.
And our Did You Know for the week takes us to some more data, this time on the appraisal side.
Our data shows that there's at least 1,400 important and useful data points that are all locked away in every narrative appraisal report that comes out. So an average of 1,400 data points. I looked back, and year to date through the end of October, our clients ordered more than 53,000 commercial appraisals through our lender platforms. So that's a grand total of 75 million data points. And that's just from appraisal documents. That doesn't even include environmental due diligence reports or any of the other documents that are involved in transactions.
And this next segment is an interesting adaptive reuse story, and it was given to us by a tip from Humanis, the Tunnels to Towers Foundation, a nonprofit organization that was founded in the wake of 9/11. They're doing some work adapting hotels and other properties to house homeless veterans. And Dianne and I sat down and spoke with Luis Menendez, who's the director of construction for the Veterans Villages, about the work that they're doing to provide affordable housing for vets. We have a lot of listeners who get involved in affordable housing in various ways and site redevelopment. So given the angle of commercial real estate and redevelopment, we wanted to spend a little time just asking what goes on behind the scenes in terms of site selection. I know that you have a number of homeless veterans projects and villages across the country.
We're not looking to build and they will come sort of philosophy. So we're out looking to the major markets where the homelessness rate is highest that could support a project of approximately, somewhere between 90 and, 120, 130 affordable units. So this stretches all the way from Buffalo to Manatee County, Florida, and across to the West Coast in California. Last year, we opened our first project in Houston, Texas. It was a former hotel, Wyndham Hotel, that we repurposed with 134 units, combination of transitional housing and permanent housing. The only distinction is that your permanent unit will have a kitchenette where the transitional unit does not. For those that don't have a kitchenette, we provide three square meals through a kitchen that is part of the first floor, where we have all the services and support that a tenant will need that may not otherwise have on their own, living in their own permanent unit. So we're looking at hotels, typically a double-loaded center corridor type structure, where you have units on either side of a central corridor, creates that secure environment where we have one point of entry on the ground floor, and all the units have internal access through a common corridor. So we're looking for that typical, not a motel type, but more of a hotel with the central core, typical lobby, which we have for entry. We have in many cases, we have a day room. So a lot of the hotels have conference areas that we convert to day rooms and multi-purpose rooms where we have a screening room for film. We provide a section for day events. You can play ping pong, you can play any kind of other table sports. And we have a gymnasium. We also have the administrative piece. So our core project has the first floor that encompasses all the administrative needs that we need to run the facility or the building, along with the services that the veteran needs. The other piece of the pie is we do ground up construction. So we build our villages, which typically encompass an 6 to 8 acre site. And we're able to create a village with that central building, multi-story building, and we build comfort homes around them. So what we call comfort homes are typically known as micro homes. These are 1-bedroom units with a living room, a galley kitchen, and a bathroom, fully ADA accessible, approximately about 500 square feet, so a little bit larger than a micro home. So, and that constitutes the village with the central building with the efficiency units on the upper floors, typically 2 to 3 floors, and with the services suite on the first floor that has the amenities, the administrative part, and administrative support. So those are our 2 types of projects.
What jumped out at me, Luis, as you were talking was, unlike Habitat for Humanity that I've done some work with before that renovates existing housing, your efforts are ground up construction, but not just of an individual house, but you recognize the importance of creating a community and creating a supportive environment so that they're not just getting housing, but they're getting what they need to really stay on their feet.
Yes, and we're not giving houses away, right? These houses or apartments or efficiency units, they're rented. So the tenant or the veteran has skin in the game. So he has to pay rent. It's minimal rent, obviously. They're only paying no more than 30% of what their income may be. So they do have a ownership on that unit, which gives them a little bit more of, hey, I really need to pay attention here and do what I have to do to make myself and again, we don't force anyone to do this. We want everyone to participate. We want everyone to succeed, but it has to be something that they want to do. We feel that having skin in the game gives you that discipline to say I have to pay a rent, and so I have to pay attention to make sure that I better myself. So there has to be some wanting to go to the next level.
I wonder when say you find an attractive property, I read about, I think it was yours in Buffalo, that was a vacant nursing home. Is the organization outright purchasing the property and taking over the construction? Are you financing it? How does that work exactly?
We purchased the property. All the projects are fully funded. We are not seeking financing. When we make a decision to go forward with a site, that site is fully paid for, so we're able to move quickly. That particular site in Buffalo, yeah, it was a building that's been there for I don't know how long. They just couldn't figure out what to do with it. Having been there for 20 years and nobody figuring out what to do gave us an advantage knowing what we wanted to do. So in the end, it became a property that we were able to raise, bring down to the ground, and start from scratch, and we're able to build it to meet our requirements. We do seek, distressed properties, obviously. Some may not be. Some of these hotels were viable at one time. They're not viable from a business perspective any longer, but they're still, good structures. They have the ability to be recreated, and that's what we aim to do. So we're looking for opportunities that fit our model, so that we're able to, and that focuses on serving the veteran, being able close to public transportation, close to a community that's willing to offer job opportunities. As part of our services that we provide, we have a workforce training program. From a workforce perspective, this is something that we provide the services to help them write a resume. We help them train for an interview. We have in our facilities, we have what we call a clothing room or a store where we take clothes that's been donated for veterans, and we offer it to them. They can come in and get themselves a suit or an attire to go on to an interview. We go as far as to really set them up to go out and get themselves placed in a job.
This is a terrific adaptive reuse case study.
It is. We think there's definitely a benefit to having all that support near you. The community is something that's key. We pay attention to the VA, where they're located, so their access, and this is something that's important to a veteran, how they access those services. So the location of the VA is or clinics that support their needs is important to us as well.
How many villages do you have already set up? What's your forecast? What are you looking
Wow, we have
toward?
quite a few. I mean, we started with Denver, right? Denver, we've had this last few months have been a whirlwind of groundbreaking. So, like I said, we've got about 10 projects right now that are in development in different parts of design. We have one under construction right now in Atlanta that's scheduled to open in Q3 of next year. But Denver, Memphis, we've got another one in South Carolina, North Charleston. That's another one that's going to be coming along real quick. These are hotels that we're going to take each room and we're going to convert with a kitchen, refinish the entire facility so that we've paid attention to the sensitivity of color, materials, and things of that nature to make it more homey as opposed to a commercial type environment. So we've got quite a number of projects that are going to be coming down the pike. So we're going to be busy this year and just getting those teed up. So we talked about those three. We've got Denver, Detroit we talked about as well. Yeah, they're going to be coming fast and furious come next year.
What kind of challenges do you face as you go to a town council or town officials to say, look, we found this vacant property and we want to jump in and take it and create a veterans village? Do you face pushback? How do you overcome challenges?
You run the gamut. Manatee County, for example, they deeded us 8 acres to build a village. Right. We want to help. We have a problem in this area. We were looking in the Tampa, Sarasota area, that part, Manatee County, and they said, we've got a problem. I think that this would fit for you guys. And we worked out a deal where they deeded us the property and we're about to embark on a 84 unit multi-story multifamily efficiency building. This is our focus to be able to rezone a project, change of use, because typically a transient hotel is not compatible to a residential use. So we need to go through those things, and we're willing to do it. We've got the consultancy support that we're able to do this very quickly, and the fact that we're fully funded when we go into a project. Once we get approval, we move just as quick. So at the same time that we're developing these projects, we are going through the process of selecting contractors, vendors. We'd have several partners that we work with to line up all the FF&E, to deal with all the components that any typical project would have, so that when we are able to get approval and go through the permitting process, which we hope they go quickly, we do get some consideration for the effort, that we're able to effectuate the projects as quickly as possible.
Luis Menendez, thank you so much for joining us today and sharing with us the good work that you all are doing on your homeless veteran program.
I love the organization, but I also love the fact, Martha and Dianne, that you guys did this. For those that don't know us particularly well, Martha and I have been doing podcasts for 4 years. Every year or two, or I should say every season, we try to highlight some organization that we think is doing good and doing great work.
If you want to hear the full interview, we'll be publishing it next week on our website at lightboxre.com. It'll be good holiday listening, so you should check it out. And I know we're going into a holiday season next week. Manis, I've got an idea for you. The Four Seasons in Midtown Manhattan has reopened this week after a 4-year hiatus, and they're poised to be now New York City's priciest hotel, which is a good sign for luxury hotels. You can get a junior suite with a king bed and a sitting area for $22.95 a night.
I don't know why this is popping into my head now, but it is. The number $22.95 just makes me think back to my college days in the 1980s, when 9 of us on spring break might have all chipped in to pay $22.95 to split one room at a Motel 6 to save money for beer down in Fort Lauderdale. I mean, I think that even now, my friends, knowing who they are and my own personal behavior, that if I was going to get the Four Seasons Hotel for $2,295 today, my buddies would still want to split the cost 9 ways to save a few bucks. So I don't know, maybe some of my friends are listening right now. They may take me to task for that insult, but we'll see.
You can get the penthouse for 80 grand a night, so you can split that up too.
We may have to throw like 90 guys into that thing.
It's probably true. Thanks to our producer, Josh Bruning. Please join us each week as our Lightbox team shares CRE news and data and context. You can listen on any of your favorite podcast channels and send your comments or questions to podcast@lightboxre.com. Thank you for listening and have a great week.
Let's go.